In 1998, the smartest money in the world lost $4 billion in 4 months. Not because of bad luck, not because of fraud, because of a mathematical model so sophisticated, so precise, so trusted, that when it broke, nobody saw it coming, including the 2 Nobel Prize winners who built it. This is the story of long-term capital management, and it is the clearest explanation anyone has ever produced for why financial markets crash. LTCM was founded in 1994 by a man named John Merriweather. Merriweather was not a gambler. He was a bond trader at Salomon Brothers, one of the most respected fixed-income desks on Wall Street. He had spent decades studying the gaps between what financial assets were priced at and what they were actually worth, and he believed those gaps could be predicted, modeled, exploited systematically. So he built a team, not just traders, academics, theorists. He recruited Myron and Robert Merton, 2 economists who had developed the Black-Scholes model, the mathematical formula that underpins how options are priced across every major financial market on Earth. In 1997, while they were working at LTCM, Scholes and Merton were awarded the Nobel Prize in Economics. The fund also employed former vice chairs of the Federal Reserve, PhDs from MIT and Harvard, people who had spent their entire careers building the mathematical tools that Wall Street runs on. This was not a hedge fund, this was a physics laboratory that happened to trade bonds. And for 4 years, it worked. LTCM's strategy was built on a simple idea called convergence trading. When 2 similar assets are priced differently, when the gap between them is wider than historical norms, you bet that the gap will close. You buy the cheap one, you short the expensive one. You wait. The models said the gaps always closed. History proved the models right. Between 1994 and 1997, LTCM generated annual returns of over 40%. Banks lined up to lend them money. By 1998, the fund controlled over $125 billion in assets. For every $1 of their own money, they had borrowed roughly 25 more. That ratio is called leverage, and leverage is the reason a smart bet can make you rich. It is also the reason a wrong bet can destroy you completely. In August 1998, Russia defaulted on its government debt. This was not entirely unexpected. Russia's economy had been deteriorating for months, but the scale of the market reaction was something LTCM's models had not predicted. Investors across the world panicked simultaneously. They did not behave like rational economic actors weighing probabilities. They behaved like frightened human beings, selling everything risky and rushing towards safety at exactly the same moment. The gaps that LTCM had bet would close did not close. They widened dramatically. The cheap assets got cheaper, the expensive assets got more expensive. Every position the fund held moved in the wrong direction at once. The model said this was almost impossible. The probability of losses this severe was calculated at less than 1 in a trillion. It happened in 6 weeks. By September 1998, LTCM had lost $4 billion. The fund that had controlled $125 billion in assets was effectively insolvent. And because LTCM had borrowed from nearly every major bank on Wall Street, its collapse threatened to drag the entire global financial system with it. The Federal Reserve stepped in. They organized a $3.6 billion private bailout, not from taxpayer money, but from the 14 banks that had lent LTCM the money it used to blow itself up. The banks paid to clean up their own mess. The fund was wound down. The positions were closed. the crisis was contained. But the lesson was not learned.
Because what destroyed LTCM was not a bad model. The model was extraordinarily sophisticated. What destroyed it was a single hidden assumption baked into every calculation: that markets behave like physics. In physics, particles follow rules. They do not panic. They do not change their behavior because other particles are watching. The universe does not revise its own laws mid-experiment. Markets are different. Markets are made of people, and people are watching each other constantly. When enough people believe a crash is coming, they sell. Their selling causes prices to fall. Falling prices convince more people a crash is coming. They sell too. The belief creates the reality it feared. Economists call this reflexivity. George Soros has written about it for decades. The price of an asset is not just a reflection of its underlying value. It is a reflection of what everyone else believes its value is. And those beliefs can spiral in either direction in ways no mathematical model built on historical data can predict. LTCM's Nobel laureates knew more about financial mathematics than almost anyone alive. What they underestimated was not the math, it was the humans. 10 years later, the same mistake. Different model, different fund, different asset class produced the 2008 financial crisis. The pattern is always the same. Leverage builds, complexity hides risk, mathematical confidence replaces human judgment. And then something unexpected happens. Not a 1 in a trillion event, but simply an event the model had never seen before. And the whole structure comes down. Markets are not physics experiments. They are collective human agreements. And collective human agreements can unravel in an afternoon. The smartest people in the room built the most sophisticated models in history, and the market did not care. It never does.